Alright guys and girls, men and women, above average Joey here, and this is the second installment of the 60-minute model. As opposed to the first introduction to this model where I did it on Nasdaq Futures, I'll now be showing you that this also works in Forex, and I will be showcasing this over a live execution that I took this week on Forex, actually the day after I took the Nasdaq trade for the introduction model. So let's begin. Starting off, I want to go through correlation analysis. The purpose of starting off with correlation analysis is to gauge a bias on where my trade is. Okay, this isn't essential for the model, but this is an essential part of how I internalize price action and why I actually took this trade. The model was just a means of entry. So we've got a lot of slides to get through, so I'll try to go through this as quick as possible without touching on too many details, but this is the 10-year intermediate term treasury note futures, okay? Now this inverts the US treasury yields. So when bond prices are going down, yields are going up. As we can see, this is bond prices as we've swept this high up here and then traded below these two up close candles and created this order block. Since then we've been in bearish order flow, and I am targeting these equal lows as a draw on liquidity. So my expectation on the T-notes, on the bond prices, is lower, which means that the bond yields would be inverted to this and rising. Now moving over to the United States dollar, with rising yields should equal a rising US dollar. So if we've got the bond prices going down, which means that yields will be inverted and going up, aiming for its respective liquidity, which would be up here in the form of buy side, then that means that we should expect the US dollar, United States dollar, to rise with the yields, which is exactly what we see. We have the week open here, we've created and engineered equal highs up here, trade down below the new week opening gap, swept these lows, and then began displacing above this high and trading above the NWOG levels and using them as support. So my objective for the United States dollar is this target up here. Now moving on to the United States Canadian dollar pair, if we're expecting the United States dollar to go up, then we would also expect United States dollar to go up in this pair against the Canadian dollar. So if we look here on the left, we've got the daily chart, and full transparency on the longer term perspective, I am looking to draw towards these equal lows, this trend line phantom, okay? But as we've taken this high, displaced lower, and we've kept running off lower, rather than just continuing to go down to these lows, look at this, we've created this displacement right here, so I want to see a retracement up into this daily SIBI. So that is my draw, taking this minor buy side. And as we can see here, we've had the week open up, drop down lower, taking this sell side, created this low, rallied higher, engineered buy side, traded down to a discount gap, engineering more liquidity, trading back to the NWOG CE, and then trading lower to a discount again, creating another trend line phantom here, and then displacing above this NWOG's levels. And we can see this displacement isn't just a common displacement, it's through the lower quadrant, midpoint and upper quadrant of these NWOG levels, so that makes it a high probability fair value gap. We can see that we retraced into this fair value gap and these NWOG quadrant levels, and then we started displacing higher. So what is the determination? What we come down to with our correlation analysis, we've got yields up, bonds down, dollar up, USD CAD up. If yields are up, that means that bonds are inverted, the bond prices, and they're going down. If yields are going up, the dollar is likely going up because the dollar follows the interest rate market. And then if the dollar is going up, that should put the USD CAD pair in an uptrend as well. Now, what does all these mean for the Euro USD pair? Yields up equals Euro down, bonds down equals Euro down, dollar up equals Euro down, and USD CAD up equals Euro down. This alone qualifies us to sought after bearishness on Euro USD before even needing to look at the price charts of EU. See, notice how we haven't even looked at the charts of EU yet, although before we even go into the Euro USD price action, we already had the expectations of looking for higher prices because of the correlation analysis that we've done. So now then, looking at the Euro USD chart, when we're up here, before we've even done any analysis, any top-down analysis, we could expect bearishness, right? Because of the correlation analysis, as I expected. But then adding top-down analysis to it, we can see that the week close here, or the previous week, the new week opened up here. We traveled lower, creating this low below this sell side, which engaged stop losses above these buy side equal highs. We've traded above the NWOG and traded bullish all the way up into this daily SIBI above these equal highs, and then we ran this high one more time, stopping out any short participants that are trying to participate in this run lower, and then we displaced lower below this low that took the liquidity, creating a market structure shift. Now from this NWOG high, we've had a retracement, and this was in London yesterday, okay? And we retraced up into this inefficiency and into these levels up here, and then we ripped off lower. I was not at the charts for this, and we had CPI 830 anyway, so I was happy to wait until a later time and not participate in this run from here. But this would have been a great swing setup, but we'll get to that soon anyway. So as we trade off lower, I am looking on how to get in sync with this run, okay? So remember, I'm looking to target down here. At the very least, I'm looking for this NWOG, CE, etc., because it resides in a discount of this range higher. Now what I need to do is identify what the daily profile is that's in play. We've retraced, created this high in London, and I expect this to stay intact. Why would I not expect to trade above this with something like CPI, whatever? Because we've already done the damage up here. Order flow is bearish. Why would we need to go back above here? Going above here again would just shift to a bullish stance, which is not the expectations that I'm under. So how would I get in sync with this? I'd look at the daily profile, and I'll be looking at this as a classic New York sell day of the London range, okay, which is just retracing into the range created in London and looking for a sell opportunity. So going into the 1 minute chart and getting some more details and looking at the actual criteria of the entry model, we can see that we have CPI right here. CPI ran up and hit the NWOG high and then started displacing lower. Now, why didn't I sell through here and sell through here and sell through here? We'd created this news volatility. We've ran this high here, created this long wick, and we started displacing lower. Aren't I bearish? Sure, but look at all these equal highs created up here. All these engineered liquidity where retail who are short would have their stops at all these highs. If not up here, trail to here, trail to here, trail to here. And I don't just expect price to just run off forever, okay? And just continue going lower. So I waited for a stop rate. Okay, now for transparency, this is those equal highs, and then this is where that stop rate comes in, okay? So this is the price action that we are looking inside of right now. We can see that we have 930 open around here, and we've traded off lower. We created these equal lows, engineering sell side liquidity, okay? Then we retrace in a contractionary state, and at 10 o'clock started climbing higher, creating this displacement and running above these stops. Now, because we are in a classic sell day template of London, we don't look for previous day and London high and even Asia high to be ran for this reversal, okay? Instead, we look for, same as last time I delineated the times, we're looking from 7 o'clock to 9:30 in that pre-market session to run these highs, okay? That's why incorporating daily profiles is very important on which liquidity and efficiency you should be targeting for manipulation and even draws. So as we run up here, we have this quick rejection during a macro, and this is inside our 9:30 to 10:30 hourly window. Then as we displace lower, we cover over the range of this entire gap right here, and this becomes an inversion fair value gap, which should not happen after taking these highs if we were to continue higher. So as we retraced up into this inversion fair value gap, I've taken my entry. We chopped around here for a little bit, reacted off this SIBI here, traded lower, retraced back to the midpoint of this inversion fair value gap, traded lower, and then retraced to the low of this inversion fair value gap, and then started displacing lower. Taking these sell stops here that were engineered and reaching into the NWOG CE. Now, I wrote this on Twitter after this execution. Didn't like NQ today, so worked on Euro USD instead. Correlation analysis set up this trade for me to begin with. Bond prices going lower, DXY going higher, USD CAD going higher. I do believe 1.15071 sell side could be in sights for this week. Now, what do I mean by that? Well, yes, I scaled off a large portion of my position here at the low-hanging fruit objective in a scalper's style, okay? But now, remember, looking at the higher time frame, we have the correlation analysis and the top-down analysis on the specific asset to tell us that we're in high probability to reach this low down here, okay? So remember what I said here, 1.15071, 1.15071. So I tweeted while we were around here that this was still my draw that I wanted to see attacked for the week, okay? So while I might have used the 60-minute model in a scalper's mindset to get in sync with this position and I'll offload my positions below the low-hanging fruit objective, I also held a runner from this stop raid and sold it below these lows. Now, admittedly, I did sell last night below this low right here as I was about to go to bed. It was real early and I didn't want to manage the position anymore. And I thought we're in close enough proximity that it didn't really matter to me. We were also in the 2 to 2.5 standard deviation range from this smart money reversal, which I'll teach more about in the future, as well as a lot of the other assets that I used for correlation had met their objectives now, which lowered the probability, even though I still did believe that this was in sights and going to be targeted as it has been. And we can see here in terms of the swing trade, once we traded off low, because keep in mind, this stop raid and this run right here below these lows into this NWOG CE is all that I participated in the scalp. But then we can see we displaced, okay, and created an imbalance through the CE of this NWOG, and we traded up into it, was wicking away, rejecting it, traded off lower, creating this other gap through the lower quadrant of this NWOG, and then retracing up into it, taking these stops, and then finally running off lower to complete my scalp to swing trade. And now, just because on CTrader I can't actually see the execution labels on my charts anymore, I'm guessing because it's been over 24 hours since I entered, so they just disappear. So here is just a screenshot of where I sold short, and then all my partial positions and terminus exit. So that is really all on the 90-minute model, but just to touch on a little bit of stuff at the end, let's look at the assets that I was using for correlation and where they are at now. So this I didn't put at the start, but this is the bond yields. Remember I said bond prices are inverted. Bond prices were going lower, aiming for these equal lows, while bond yields are rising, aiming for these equal highs. See here on the 1 hour that we were climbing above this new week opening gap. Once we got up here, we retraced into this NDOG and gaps, and then started trading higher. Now this is the T-notes and the bond prices, which were trading lower. Remember, these equal highs are just inverted to these equal lows. Now, something about both of these is that neither of them have actually reached their liquidity pools yet, which does tell me that there's a possibility of further continuation in this direction for the rest of the week, which is just 1 day left. But as the bond prices have not reached these equal lows yet, and we're in close proximity, as long as we don't trade above this inversion fair value gap here, I expect us to continue trading lower, which does mean that Euro USD could continue to further sell side objectives for the week, okay? Now, looking at the United States dollar, we can see that this was the daily chart where we traded down into the high end of this suspension block and we begin trading higher. Got our MWOG here, trading below it, displacing up to this order block, trading up these MWOG levels, creating this new day opening gap, engineering some liquidity there, engineering buy side up here and taking this buy side, coming back down to this order block and filling this end dog, and then rallying higher for the day, taking this buy side here. But like I said, with yields going higher and not meeting their objective yet, that could push the dollar even further up, as we still do have this objective up here. But I would be watching the event horizon of the midpoint of these two liquidities to see if we can get above that. And then the USD CAD pair, where was this? Well, we can see here again on the previous day's trading. After trading above this NWOG and we're hovering around this CE, we took these stops and then began trading higher. We actually did meet this objective here before Euro USD met its sell side objective, but as you can see, we just kept rallying through to this imbalance here on the 1 hour. And that is from start to finish how I paired the correlation analysis with the analysis on the actual asset that I was trading, which was Euro USD, from start to finish. And this is also how I assessed the top-down analysis of that asset, of the direction and reference points of where it was likely to trade to and trade from, and then how I utilized the 60-minute model to get in sync with the daily expansion and used that daily expansion to get in sync with the weekly expansion. So that is all I really have for you guys today. I hope you enjoyed this. I will do more and touch more on the 60-minute model, and all topical things in this will be in future lectures. I appreciate you guys watching and listening. Looking forward to speaking to you guys next time. Ciao.